What if I told you that most of the investing advice you've seen online is wrong? That what has been working for the past several years may not work going into the future? In this video, I'm going to give you exactly 3 reasons why that is the case so that you have a better idea of what to do with your money going forward. Hi, I'm Milan. I'm an economist and I have been studying the stock markets for the last 15 years. Reason number one, the advice you're given is generally misleading. Let me explain. So you're normally told to invest in a low-cost index fund, something that tracks the S&P 500 or a global tracker. Now the reason is because generally the S&P 500 has historically delivered an average of 10% each year. And you're also told about compound interest, where the more you add to your investments, the more that money will grow, which makes sense, right? If you invest £1,000 and it grows by 10% over the course of a year, it becomes £1,100. That's a £100 gain on your investment. If you invest £10,000, then 10% of that is £1,000. So you see how the more money you have and invest, it compounds, it grows by more and more. And if you have £100,000, it can become £110,000. Now, if you don't invest anything at all, then the following year you're starting with effectively £110,000 that can grow to £121,000. So in year one it grew by £10,000, in year two it grows by £11,000, and you haven't done anything, and it's grown by 10% each time. That is compounding annual gains. However, here's the reason why I believe it is misleading. You see, what they don't tell you is that your money is not guaranteed to grow. And we have seen that over and over again. If you had invested £1,000 back into 1999, then 2 years later, that money would have been worth around £300. So you would have been down several £100 from your initial investment. And my point here is that you need to be mentally and monetarily prepared for that to happen, which I don't think many of you are. Most people now are investing in the stock markets because we've all seen the rapid gains over the past few years, and we're afraid of missing out. And at the end of the day, we all want more money. So it is our emotions that are driving these decisions. But as you can see, this happened in the year 2000. It happened again during the 2008 financial crash. It happened again in 2022, in fact, where over the course of almost the entire year, the stock markets came down. And so you have to be prepared to be losing money for a period of time. So you should only be risking money that you don't need, but you should also be aware of what you're investing in and why. Because generally speaking, the people who made the most amounts of money were those who invested after the dot-com bubble burst. They invested after the great financial crash of 2008, when stocks were at their all-time lows. That is when the real money was made. It wasn't made by people who were buying in 2007 and then added small amounts to their investments over time. The biggest money was made when those who could see what was coming waited and kept their money aside and invested after the crash. And so this is what I'm trying to explain to you, is that generally speaking, investing after a crash can yield far higher returns than simply blindly investing and hoping that your money will just grow every single year. Number two, and this is blindly investing. So this follows on from my first point of dollar cost averaging, or putting money into your investments every single month without really paying attention to what is going on in the economy or what you're investing in. And I do believe that blindly investing is actually the reason most investors lose money. Let me give you a very, very clear example. Let's imagine you're here in the UK and there is an index fund that tracks an average of 100 homes spread out around the UK. So let's imagine that the average rental income for these properties is £1,000 a month or £12,000 per year. But the average value of those properties is around £1 million. So you're investing in something that is worth £1 million, but you're only expecting to receive £12,000 per year as a yield. Now, would you think that's a good investment? In my opinion, I would say that's overvalued. Well, that is what is going on in the stock market, where it's almost a social media trend to tell people to just invest in the S&P 500 and put in a small amount every month. It would be like me telling you to invest in this fund that is tracking these house prices around the UK, while these house prices are £1,000,000, and yet they're only returning £12,000 per year. Like, if that were me, I would be thinking that is pretty expensive. And perhaps it would be better for me to wait or find an investment that gives me a much bigger potential, to increase in value. So that is my point number 2. It's blindly investing in something and not really paying attention to what you're investing in. So investing in something that is overvalued is generally going to give you lower returns or potentially losses compared to doing some research or just waiting until things become fairly valued or even undervalued. Where, for example, that property or that group of properties, the average price falls from £1,000,000 down to £400,000. Because can you imagine those people who waited for a property crash would be able to pick up these properties at such a huge discount, knowing that in the future the economy will probably pick up again and the prices will increase. But all of those who invested a little bit amount of money every month, who could continue to only afford to invest a little bit amount of money every month when the prices crashed, aren't going to get the biggest returns on their investment. And this is what we're seeing with the stock market right now. For example, you have a company like Palantir, whose stock price is about 400 times their earnings. So in this example, it would be like saying the rental yield is £12,000 per year, but you're going to be paying 400 times that £12,000 yearly rental. That is insane. That is crazy in my opinion. And that is what we're seeing a lot of in the stock market. Not every company is that bad, but that is kind of the trend that we're seeing. Now, this brings me on to point number 3. And that is that this time is different. And let me explain why. So right now, you're going to see a lot of people comparing this time to the dot-com bubble. Are we in an AI bubble? And is it similar to the dot-com bubble? In this video, I want to explain why they're different. And by the end of this section, you will understand my point, because it is very, very clear that these two are different. You see, during the dot-com bubble, if me or you had started a website, let's say we bought a domain, and this web domain was called findmynextword.com. Completely random bunch of words, right? But because we've bought the domain, we could start up a company and list it on the stock market. You know what? Even without a business plan, investors were dumping in millions of pounds of investments into these kind of companies. You can imagine how crazy this sounds right now. If I just come up with a name for a company, do all the paperwork to register it, and then float it on the stock market, I would certainly not to expect zero investment, let alone £1 million or £10 million worth of investment. And that is exactly what was going on. So that was the dot-com bubble back then. What is happening now is that you've got companies that have revenue and are profitable, like Microsoft, like Google, like Nvidia, but their valuations are through the roof. Their valuations are absolutely through the roof. But not only that, Microsoft, Meta, Google, Amazon, they're all spending ridiculous amounts of money. In fact, what they're doing is borrowing money to spend more money than they're earning every year to invest in data center infrastructure that isn't guaranteed to generate any returns. And that is what we're seeing right now. But there is another major difference which actually solidifies all of this and the reason why I'm making this video. The AI bubble and the dot-com bubble are not the same. During the dot-com bubble, what happened was the invention of the internet started to boom. And during that time, yes, some companies who didn't adapt went out of business. If you didn't have an online store, then you went out of business. But what the internet and websites enabled was e-commerce. So for example, if you wanted bamboo from China, you'd have had to fly to China, locate a factory or wherever you buy bamboo from, and find a person and then buy that bamboo and then come back and ship it back. But with the invention of the World Wide Web, with websites, you wouldn't have to go anywhere. In fact, you could purchase that same bamboo from the comfort of your own home. All you would have to do is locate the website and enter your credit card details. That's it. That's literally it. And what this happened was it connected global economies together like never before. And that actually created a net result of building and growing global economic growth. But what it also did was build entire industries or allow entire industries to be built around this. For example, web design, web development. You have computer development. You had data and analytics. You have online advertising, internet advertising, email marketing. So many industries that have been built around this. You've even got warehousing, logistics, because of all the new e-commerce. So many different industries have boomed as a result of the World Wide Web and effectively the result of that dot-com era, where companies that were built purely to be online were able to thrive, create jobs, and allow other businesses to grow on the back of it. Now, that is different to what is happening today, because you've got a few companies that have put this software out into the world, and this software is taking the jobs of many people like you and me. So we know that AI or AI tools are now allowing people to do double the work. So rather than have 10 people in a team, you can get rid of 5 people and only have 5 people to do the work of those 10. And what you're seeing is that jobs are being lost, but they are not being replaced. And this is very different to what happened with the World Wide Web, where it actually enabled new industries to be built on top of it. But new industries aren't going to be built on top of jobs being lost, because that doesn't happen. And so this is very different to back then. Now, if you extrapolate this forward, and this is already happening right now, is that you will see more and more people lose their jobs. Those jobs will not be replaced, and you will see unemployment start to rise. Now, we've already seen that here in the UK with unemployment at 5% and continuing to grow. We're seeing the US unemployment creep up to around 4.5%. I think it's around 4.2 or 4.3 right now, but it is growing. And we're seeing that same trend happen around the world. What we're also seeing now is that as unemployment rises, people have less money to spend, less disposable income. So what we're starting to see is retail spend go down. And the result of that is going to be an economic slowdown. Because when people do not have money to spend, because they do not have jobs, it means they will start to default on their loans, they will lose their houses, they will lose their cars, and they can barely afford to eat. As a result of that, you're going to see a slowdown in the global economy. Now, I know that economists are saying, well, that will cause a decrease in interest rates to spur on economic growth. But a decrease in interest rates normally works because companies can take on more debt, they can be more productive, they can take on the debt and employ people to do more work, to do more research and development in their products, to do more marketing and so on. But what we're seeing happen now is that companies will take on more debt and push that debt towards AI tools. So the jobs that are being lost are still not going to be replaced, even with lower interest rates. And that is a very big problem. And that is why it is important to understand what you're investing in. So this brings me back round full circle to the 3 points that I made. Number one, do not blindly invest. Number two, if valuations are extremely high right now, then it isn't really worth investing your money. Wait for valuations to improve and invest when there is an opportunity to actually invest. There's no point investing for the sake of investing and hoping for the best. And number three, this time is different because this time we have a tool or a set of tools that are replacing jobs. That has never happened before. So I'm not saying don't invest. It's always good to invest, but just know what you're investing in and why. If you like the video, please leave a thumbs up. I'll see you on the next one.